Welcome to the deep dive. Today, we're really getting into the weeds of financial difficulty in the UK, specifically the legal side of things. This stuff matters, whether you're facing personal debt issues or just trying to grasp how businesses handle things when, well, things go south.
It's a complex area, definitely. Lots of jargon flying around.
Exactly. So we've looked through all your source materials, legal guides, articles, case notes, and our aim today is pretty straightforward. To give you a clear picture of these insolvency mechanisms, we really need to nail the difference between just being short of cash and, formal bankruptcy.
And understand the consequences, which can be severe. Plus, looking at the alternatives that might be available.
Right. So let's start with the terms themselves. Insolvency versus bankruptcy. They're not the same thing, are they?
No, absolutely not. Insolvency is the broader term. Basically, it means one of two things.
Yeah.
Either your liabilities, your debts, are greater than your assets, or, perhaps more commonly, you just can't pay your debts as they actually fall due.
So you might have assets, like a house, but no ready cash.
Precisely. And that's key. Insolvency might just be a temporary cash flow issue. It doesn't automatically mean financial ruin.
Okay, so that's insolvency. Then what's bankruptcy? Is that the next step?
It can be. Bankruptcy is the specific legal process for an individual in England, Wales, and Northern Ireland, EW and NI, who is insolvent and, crucially, has no real prospect of paying their debts back.
So it's about the outlook being bleak.
Yes, it's a formal declaration of that state.
Okay.
And just a quick side note, if you're dealing with this under Scottish law, they call it sequestration. It's run by the accountant in bankruptcy up there.
Mm-hmm.
But yeah, we'll stick to the EWNI system today.
Got it. And the main law governing all this is the Insolvency Act, 1986. Seems quite old.
It is the cornerstone, yes, the 1986 Act. But it's been updated, of course. One big practical change we saw mentioned is that since April 2016, the whole application process for bankruptcy went online.
Which probably streamlined things quite a bit, moving away from purely court-based procedure.
Definitely made it more accessible,
Right.
in a way, though the implications are just as serious.
Okay, so let's unpack the actual process of becoming bankrupt. How does it start? I noticed there seem to be different rules depending on who kicks it off.
That's right. If you, as an individual, decide you need to declare bankruptcy yourself, that's called a self-petition. And interestingly, there's no minimum amount of debt required for you to do that.
Really? So you could technically do it even for a small amount if you genuinely can't pay?
Technically, yes. You're essentially admitting you can't meet your obligations, whatever the sum. But it's different if a creditor tries to make you bankrupt.
This is the 5,000-pound figure I saw.
Exactly. A creditor, or a group of creditors together, must be owed at least £5,000. And that debt usually needs to be undisputed before they can petition the court to make someone bankrupt.
5,000 pounds, that feels like quite a barrier. Does it sort of protect people from very small creditors using such a heavy-handed tactic?
I think that's part of the intention, yes. It pushes creditors with smaller debts towards other methods, like, getting a county court judgment and then trying enforcement that way, rather than jumping straight to bankruptcy, which is costly for everyone involved.
Okay, so the order is made. What happens then? There's this discharge period, right?
Yes. Once the bankruptcy order is made, the clock starts ticking on the discharge period. Thanks to the Enterprise Act 2002, the standard period is now typically 12 months.
Just 1 year? That seems quite short for something so serious.
It does, but the idea was to reduce the stigma and allow people a quicker, fresh start. However, during that year, you are officially an undischarged bankrupt. And that comes with a lot of restrictions we need to talk about.
And crucially, discharge after 12 months doesn't mean all the financial obligations just vanish, does it?
Not necessarily. While the restrictions associated with being an undischarged bankrupt usually lift after 12 months, you might still have to make payments toward your debts for longer.
How does that work?
Through something called an income payments order, or IPA. If you have enough disposable income, the trustee can arrange for you to make regular payments, and those can last for up to 3 years in total, even after you've been discharged.
Right, so the discharge mainly lifts the personal restrictions, but the repayment aspect can continue.
Correct. And that brings us to what actually happens to your stuff, your assets, when you're made bankrupt. This is often, the biggest immediate shock for people.
Yeah, what's the deal here? The sources talk about control passing to someone else.
That's right. The moment the bankruptcy order is made, legally, control of almost all your assets passes to either the official receiver, who's a government official, or a private insolvency practitioner appointed as your trustee in bankruptcy.
So they take charge of everything you own.
Pretty much. Their job is to gather your assets, sell them, and distribute the money to your creditors according to specific rules. But importantly, the law does protect certain essential items.
Okay. What kind of things are safe?
Things you genuinely need for basic living clothing, bedding, furniture, basic household items, and critically, things you need for your job or business.
Like tools of the trade.
Exactly. The example used was Damien the plumber. If he's made bankrupt, he'd generally be allowed to keep his essential tools and maybe even his van, if he needs it, to continue working and earning. The idea isn't to make someone completely unable to function or earn a living.
That makes sense. What about family? If you're married or in a civil partnership, are their assets at risk?
Generally, no. Debt liability is separate. If the debt is solely in the bankrupt person's name, the trustee can't usually touch assets owned solely by the spouse or partner.
But joint assets like a house, that's different.
Yes, property is often the most complex part. If you own property, jointly or solely, the trustee will look at the equity, the value, minus any mortgage. If your share of that equity is more than £1,000, then your interest in the property becomes part of your bankruptcy estate.
And what does that mean practically? Forced sale.
It often leads to that, yes. The trustee will want to realize that value for the creditors. If it's a family home, there's usually a mandatory 12-month delay before they can force a sale to give the family time to make other arrangements.
Or could the other owner buy out the bankrupt person's share?
Yes, that's another common outcome.
Hmm.
The joint owner, perhaps the spouse, finds the funds to buy the bankrupt share from the trustee.
Now, there was a really interesting point in the sources about a time limit on this property aspect, something about 3 years.
Ah, yes, the 3-year reversion rule. This is absolutely crucial. If the trustee hasn't taken certain actions regarding your interest in the property within 3 years of the bankruptcy order, actions like selling it, getting a charging order against it, or starting possession proceedings,
Then what?
then your interest in the property actually automatically transfers back to you, the bankrupt. It basically reverts.
Wow. So the trustee is really under pressure to deal with the property relatively quickly?
They are. It provides a significant degree of certainty for the bankrupt individual about their home in the slightly longer term, if the trustee doesn't act. It's a powerful deadline.
Okay. What about things that happen after bankruptcy starts, or things you did before? Can the trustee look at those?
Definitely. Any windfalls you receive while you're still an undischarged bankrupt, think lottery wins, inheritances, they can generally be claimed by the trustee.
And looking backwards, can they undo past transactions?
They can. The trustee has powers to investigate transactions you made before bankruptcy. They can attack transactions where you might have given assets away or sold them for significantly less than they were worth, essentially trying to put assets beyond the reach of creditors.
How far back can they look?
Generally, they can look back 2 years before the bankruptcy order. But if you were actually insolvent at the time you made the transaction, or if that transaction made you insolvent, they can potentially look back 5 years.
Right, so trying to shift assets when you know you're in trouble extends that look-back period.
Precisely. One other major asset people worry about is pensions. What happens there?
Good question. The general rule is that funds held within approved registered pension schemes are protected. They don't form part of your bankruptcy estate, so the trustee can't normally claim your pension pot itself.
That must be a huge relief for many people.
It is. However, there's a catch. If you're already receiving payments from your pension like a regular income, or you take a lump sum before you're discharged from bankruptcy, the trustee can apply for an income payments order to take a portion of that money for your creditors.
So the pot itself is safe, but the income stream from it might not be while you're undischarged.
Exactly. Okay, let's move on to the restrictions. What can't you do when you're an undischarged bankrupt? This seems to impact daily life quite significantly.
It really does. First off, credit and banking become very difficult. While you're undischarged, you'll typically only be able to get a very basic bank account. No overdraft, probably no standard debit card, certainly no credit cards or loans.
And does that difficulty continue even after discharge?
Yes. The bankruptcy stays on your credit record for 6 years, making it hard to get mainstream credit for a long time afterwards. Even after discharge, you legally have to declare you are bankrupt if asked when applying for credit. Not doing so could be fraud.
Okay. And there are actual criminal offenses you can commit while undischarged too?
Yes, there are specific bankruptcy offenses. The main ones are 1. Getting credit of £500 or more from any single source without telling that lender you're an undischarged bankrupt. That's a serious offense.
So you have to actively disclose it.
You do. Second, trading under a different name from the one you were made bankrupt in without telling everyone you do business with the original name.
Trying to hide the bankruptcy, basically.
Exactly. And third, you generally can't be involved in the promotion, formation, or management of a limited company or act as a company director without getting specific permission from the court.
Right. And that restriction on roles extends further, doesn't it? Public office, trustee roles.
Yes. An undischarged bankrupt can't hold certain public offices, like being an MP or a justice of the peace. You also can't act as a trustee for a charity or most pension funds.
And there was a key point about lasting powers of attorney, LPAs.
Ah, yes. This is critical. You cannot act as an attorney under an LPA while you are an undischarged bankrupt. If you are already appointed, that appointment automatically ends the moment you become bankrupt.
That was the Charlie case study, wasn't it? His bankruptcy meant he could no longer manage his father's affairs under the LPA.
Precisely. Because bankruptcy is seen as undermining the financial trustworthiness required for that role. It's a really important, often overlooked consequence.
Okay, so the consequences are clearly pretty far-reaching, which naturally leads us to think about how to avoid formal bankruptcy if possible. What are the structured alternatives?
Well, there are mechanisms designed specifically for that. The main one for individuals is the Individual Voluntary Arrangement, or IVA.
Right, the IVA. How does that work?
Basically, it's a formal, legally binding agreement between you and your creditors, where you agree to pay back a certain amount of your debt over a set period, typically 5 or maybe 6 years.
So it's a negotiated settlement. Does everyone have to agree?
Not quite everyone, but a significant majority. It needs to be set up and supervised by a qualified insolvency practitioner. And crucially, it has to be approved by creditors who represent at least 75% of the total value of the debt of those who actually vote on the proposal.
75% by value. So one big creditor could potentially push it through or block it, even if lots of smaller creditors disagree.
That's exactly right. It gives significant weight to the larger creditors. But the benefit for the debtor is that, if approved, interest and charges are usually frozen. And often, creditors agree to write off a portion of the debt at the end of the term, provided you stick to the payments.
So it can be better for creditors than getting potentially very little in a bankruptcy.
Often, yes. And for the debtor, it avoids bankruptcy, although getting credit while in an IVA is still very difficult, and it stays on your credit file for 6 years from the start date.
Okay, so that's the IVA. Then there's the debt relief order, the DRO. Who is that aimed at?
DROs are specifically for people with, frankly, very low income, minimal assets, and really no prospect of their situation improving. It's sometimes called bankruptcy light, but the eligibility criteria are extremely strict.
How strict? What are the limits?
There are several key ones you have to meet all of. First, your total debts must be less than £50,000.
Okay, less than 50 grand. What about assets?
Your total gross assets can't be worth more than £2,000. There is one important exception, though you're allowed one vehicle worth up to £4,000, which doesn't count towards that £2,000 asset limit.
So a basic car might be okay.
Yes. And the third, often the hardest hurdle, is your disposable income. After covering taxes, national insurance, and essential household expenses, your leftover disposable income must be no more than £75,500 a month.
Wow, only £75,000 per month. That is tight.
It is. And you also can't have had another DRO or been bankrupt in the previous 6 years. You have to apply through an official approved intermediary too. You can't just do it yourself online like bankruptcy.
So going back to the Charlie example, he had debts under £50, minimal assets, but his disposable income was £120 a month.
Exactly. That £120, while not a lot, is still over the £75,000 threshold. So a DRO wouldn't have been an option for him. An IVA might have been, depending on creditor agreement, or ultimately bankruptcy.
It really shows how specific those limits are. What does the DRO actually achieve if you qualify?
If granted, it gives you a 12-month moratorium period where your creditors included in the DRO cannot chase you for the money or add interest. If your circumstances don't significantly improve during that year, the debts are usually written off completely at the end. It's a real lifeline for those who qualify.
Okay. And briefly, there's a company equivalent too, the CVA.
Yes, the Company Voluntary Arrangement. Similar principle to an IVA, but for limited companies or LLPs. It allows a struggling but potentially viable company to reach a binding agreement with its creditors, including HMRC, often to repay debts over time, usually while the existing directors stay in control.
And does that also need creditor approval?
It does, yes.
Yeah.
Again, it typically requires creditors representing 75% or more of the debt value to vote in favor.
Right. So Pulling all this together then, we've seen the difference between just being insolvent, maybe temporarily unable to pay bills, and the formal legal status of bankruptcy in England, Wales, and NI.
Yeah, and the serious impact bankruptcy has on your assets, although with key protections for essentials like Damien the plumber's tools and van.
And we've looked at those key alternatives, the negotiated IVA repayment plan, and the very restricted DRO for those with minimal income and assets, and the CVA for companies.
I think the main thing to take away is just how important the specific rules, the numbers, the timelines really are. That £5,000 creditor threshold, the £1,000 equity rule for property, the £500 credit offense limit, the super strict 75 income cap for a DRO.
These aren't just guidelines, they're hard boundaries that determine which path, if any, is actually open to you.
Absolutely. Understanding those details is critical.
Okay, so we'll leave you with a final thought to chew on, circling back to that property rule. The law says if the trustee doesn't sort out the bankrupt's interest in their home within 3 years, it reverts back to bankrupt count. Why that specific time frame? What does it tell us about the balance the law tries to strike between getting money back for creditors and giving the individual a genuine chance to move on, a true fresh financial start? Is it just about trustee efficiency, or is there a deeper principle at play about finality? Something to consider.